There's just a degree of unpredictability in foreign policy in general these days that I don't think we've wrestled with, at least in my professional career. And I just think that we need to keep that in mind.
Hi, welcome to Market Matters, our market series on JP Morgan's Making Sense. I'm Eloise Goulder, and today I'm delighted to be sitting here in New York with William Tuttle, who is Executive Director for Global Engagement, to dive into US policy and the evolving world order. So, William, thank you so much for joining us here today.
Thank you for having me.
So, William, could you start by introducing yourself and your background?
I'm part of a team called Global Engagement. We're based in Washington, D.C. What we do is track, monitor, analyze the implications of U.S. foreign policy for the firm and for our clients. Before joining JP Morgan, I was vice president for political risk and security at a small energy firm based in Texas. And prior to that, I spent 16 years in the U.S. intelligence community and State Department.
And I'm really looking forward to hearing your perspectives on the political and the geopolitical, William, and coupling that with perspectives on the markets. And I think one really important debate this year, which couples both those facets, is US exceptionalism, a theme that worked so well in markets over the last decade or so, but a theme that really underperformed through the market drawdown of February to April this year, during which the S&P 500 lost about 20% peak to trough. It sharply underperformed other global indices, albeit the US has been outperforming since then, but certainly questions around US dominance have been absolutely at the forefront since then. And I guess this comes down to questions around both US policy and foreign policy, but also to questions on technology and the global AI race. So, William, could we start with US policy, and can you tell me your thoughts on the impact of the tariffs that have been announced?
The interesting thing about tariffs is that we tend to look at the Trump administration as having made this giant move earlier this year, but the impulse to place tariffs in the United States goes back a number of years. And I think it's worth keeping that in mind as we're looking at this. In Washington, when I was coming up as a young professional, free trade really drove U.S. foreign policy, or at least it was a key pillar. Now, I would say in Washington, there's really no policy constituency that has a free trade agenda, which is quite remarkable. We've entered this new phase where tariffs are becoming more acceptable. And that's led to some questions that we hear from clients, which is, what are we trying to do with tariff policy? So, we see a number of reasons that explain what the government's trying to do. And one that's talked about quite a bit is to try to bring manufacturing jobs back to the U.S. Another one is in the national security realm, and we saw some of this under the Biden administration as well, which is we need to protect certain critical supply chains, and tariffs can help do that. And there's one more thing that tariffs are helping accomplish for this government that I think will make them sticky over the long term, and that is they're creating revenue. They created upwards of $30 to $40 billion in revenue last month. You stretch that over a year, and that's a significant piece of revenue for the government, a government that has in the past struggled to generate new sources of revenue. Now that these tariffs are in place, I tend to think that they're going to stick a bit. And even if we look at the Supreme Court decision that's going to come up at the end of this year, maybe beginning of 2026, where they're going to rule whether the actions that the Trump administration have taken are consistent with the International Economic Emergency Powers Act, IEPA. And even if it throws out the administration's tariffs, the administration will find ways to put them back in place. So I tend to think that's where the policy direction is. The impulse is towards tariffs. They'll probably settle at a lower level than what we're seeing right now, but I think they're here to stay for a few more years at least.
It's really helpful to hear the context and the rationale for the tariffs, those three core reasons. But I guess the question is, what are the costs against that? And I would argue from a markets and from an economic standpoint, the big questions this year have been when and if we would see a corresponding growth decline and or inflation increase associated with those tariffs. Because, of course, there's a question as to how much the goods that were otherwise imported from abroad will be substituted by US manufactured goods. But other things equal, one would expect some sort of a hit to growth, some sort of an increase in costs and inflation. And yet we haven't really seen that. Has that debate been coming up in your circles?
Yes, the questions that we're getting from clients are when there will be a corrective course by the administration, because the expectation is that there will be impact on growth at some point. We haven't seen a change in policy from the administration yet. What we have seen are a series of deals cut with individual trading partners, countries that have historically been close to the United States. Those trade agreements take a long time. They're very complex. We've seen announcements around those, but not a lot of concrete progress. And historically, the U.S. has worked very closely with allies. And right now, there's a little bit of an expectation around, okay, well, where are these talks going to go? Where are they going to end up?
So the US authorities still need to conclude these tariff discussions with these bilateral countries. But the other debate that's been coming up in markets is the extent to which the One Big Beautiful Bill Act, which only came through in July, could have an offsetting impact on growth to the extent that there are multiple tax cuts in that bill. That could be a boost to growth, an incentive for growth, and that could offset some of the tariff dynamics. Is that something you have a view on?
Well, maybe so, actually. And so that's one thing that could counter some of the tariff implications.
Moving on to AI, when we look back to the underperformance in US equities through February, March this year, one of the narratives, of course, was the impending tariffs and their impact on growth and inflation. But another argument for US equity underperformance was competition from China. And indeed, the DeepSeek R1 model was released in January and showed enormous success in terms of downloads over the next few weeks. The US has certainly been the leader in terms of cumulative AI-related capex to date. William, do you believe the US will continue to dominate in this field?
Well, I think this is probably one of the most important questions that we'll be talking about for the next several years. Clearly, the United States has put a premium on innovation and pushing the frontiers of AI in a way that contrasts slightly with the Chinese approach, which is more focused on ensuring that AI is integrated into its economy as quickly as possible. But the Chinese are catching up. Their homegrown chips are getting better. So I think this is really the race of the next 25 years.
So when we put this all together, both the policy developments with tariffs, their impact on growth, their impact on inflation, their impact on US foreign policy, and then we couple that with the AI race and technological developments in all economies globally, what do you think this means, William, for the changing world order? And what do you think this means for the US in the longer term?
I see a U.S. that is pulling its horns in. It's focused more and more on its immediate neighborhood. And there are good reasons to do that. The administration has made fentanyl a priority. It's made immigration a priority. These are huge challenges for the United States, and they're deserving of policy attention. But they're less about pushing a broader free trade agenda, some value-based policy across the globe. So it's a very transactional foreign policy right now. We're sort of entering this age of transactionalism. And I think that will lead to questions about long-term durability of U.S. partnerships to the extent that it maintains them and sustains them abroad. All that being said, the U.S. is still hugely dominant economic player on the global stage, spends more than any other country on its military, is able to project power still in very real ways.
And of course, these much longer term themes in markets should play out in the longer term growth premia and or the longer term risk premia. But in the near term, there have been many supportive factors for US equities this year, which help justify and explain the strength year to date. On the macro front, in spite of tariff news and tariff uncertainty, the US economy has continued to deliver around 2% growth so far this year. On the micro corporate earnings front, I think that's been a really remarkable story because not only have we seen the S&P 500 deliver around 10% earnings growth in both Q1 and Q2 this year, but we've actually seen evidence of a broadening of the earnings base within the US. So it's no longer the Mag 7 and the tech names which are really dominating earnings growth, but we've actually seen nearly 10% earnings growth from the S&P 493 and the non-tech segments of the market. That is a marked change versus the prior 2 years. And then from a policy perspective, you've seen the Fed cutting rates. The market is anticipating further cuts through the course of this year, and other things equal, that is positive for equity markets. So I do believe that all three of those drivers help explain equity markets year to date. But William, from your perspective, as you look ahead, which economies outside of the US really stand out to have tailwinds at this stage?
It's a great question. I look at the Gulf countries, Middle East in particular. I think that there is the opportunity for real growth there, real dynamism. There is, in the world of international affairs literature, a lot of talk about this being a middle power moment where countries like Turkey, Indonesia, South Africa, or Brazil find themselves in a position where they're being competed for by the great powers, China, the U.S. And is this an opportunity for them to leverage what advantages they have? Potentially. So I think this could be a middle power moment for some of those countries. The final thing on China, the Chinese are watching what the U.S. is doing and not changing much of what they're doing at all. And I think their stature is almost rising globally by default. And we saw recently with the Shanghai Cooperation Organization meeting, SCO, bringing together world leaders in a way that we hadn't seen China do previously.
And of course, from a markets perspective, emerging economies as a whole have performed very well, have outperformed US equities year to date. And the weaker dollar, particularly those that have dollar-denominated debt, alongside access to commodities, has been highlighted as another supportive pillar for many of those economies. So, William, we've discussed so many topics which are widely debated already amongst both the political, geopolitical community and amongst the markets community. Tricky question to close, but are there any less discussed topics, or perhaps I should say known unknowns, that you believe are important?
Sure. So I would just say don't sleep on the conflicts that we know about already in terms of the geopolitics. And there are some other things, again, from a geopolitical perspective that I watch. One of them is in the South China Sea, where the U.S. has a mutual defense treaty with the Philippines. And then there's just a degree of unpredictability in foreign policy in general these days that I don't think we've wrestled with, at least in my professional career. And I just think that we need to keep that in mind.
There's clearly so much to watch, whether it stems from US policy changes and the implication of tariffs to AI dominance, technological change, and as it pertains to geopolitics across the globe. So thank you very much, William, for taking the time to go through all of this with us today.
Well, thank you, Eloise. We probably just barely scratched the surface, but it was a pleasure being with you, and I'm happy to come back anytime.
Thank you also to our listeners for tuning in to this regular podcast series. If you have questions or if you'd like to get in touch with our team, then please do go to our website at jpmorgan.com/market-data-intelligence. And with that, we'll close. Thank you.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, and YouTube. The views expressed in this podcast may not necessarily reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan. They are not the product of JP Morgan's research department and do not constitute a recommendation, advice, or an offer or a solicitation to buy or sell any security or financial instrument. This podcast is intended for institutional and professional investors only and is not intended for retail investor use. It is provided for information purposes only. Referenced products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures/sales and trading disclaimer. For the avoidance of doubt, opinions expressed by any external speakers are the personal views of those speakers and do not represent the views of JP Morgan. Copyright 2025 JP Morgan Chase & Company. All rights reserved.